Hello everyone and welcome to the YouTube channel of BeingACCA. This is Tushita Gupta, ACCA affiliate, and with this video I'm marking the beginning of my FM chapter-wise revision series. So I got some great feedbacks on the PM revision. It helped the students a lot. It was a free, YouTube video resource which I put up for the students who were appearing for their exams. So they were telling me how useful it went for them. So I'm trying to create something similar for the FM students also, so that once you are in the final stages of your preparation, you can watch these videos for a chapter-wise revision. Now, just for your knowledge, the chapters are going to be in accordance with the ACCA Study Hub. So that is going to be my base, and whatever has been covered chapter-wise over there is what my chapters are going to look like. So according to the Study Hub, your financial management syllabus has 19 chapters. So with this, you will find 19 videos syllabus, chapter wise for revision of your syllabus. So this video will pertain to chapter 1. This is the starting of the series, hence an introduction. Now from the coming videos, we'll straight away be beginning with the chapters. So now let's move ahead and begin our revision with the chapter 1 itself. So if you read through the index of your study hub, the name of your chapter 1 is the role of financial management. So basically, what all does it consist over there? I'm sorry, this is not the name, but this is, what all it consists. So it talks about strategies, it talks about objectives, what objectives can a business have, and also some conflicts that can arise in a business. Naturally, we are in an environment where humans are, dealing with the day-to-day things. So conflicts are bound to arise. So this is what the chapter overview looks like. This is what we will be talking about. So the name of our paper is Financial Management. So it is imperative that we understand what the definition of financial management is and what do we really mean by financial management. So if I just give you the definition that has been provided, so the definition is that financial management is the efficient acquisition as well as use of both short-term and long-term financial resources. Now, what do we mean by this definition? Let us break this down. So, if the first word talks about efficient acquisition. This means the money that is going to be used in the business needs to be acquired efficiently, needs to be raised in an efficient manner that, we are minimizing the issue costs, we are getting the right sources, to fund our money from. And then ultimately, once you have the money in the business, it also is about the efficient use of those resources. So maybe if you have obtained some money, obviously that will be there at a cost. You might have, if it's a loan, you might have to pay interest. If it's equity that you have raised, you might have to pay dividends to your shareholders. So you need to make sure that you're using that money productively so that you are not only able to deliver the commitments that you have made, interest on your loan or dividends to your shareholders, but also generate extra additional profits through which the business will thrive. So this will pertain to both short-term as well as long-term financial resources. Financial management will optimize both the resources, the way that they are used. So this is what we briefly mean about the definition of financial management. Now, when it comes to financial management, there are three main decisions that are required while performing financial management. First decision is what you call your investment decision. I'll first name all of them and then explain what all of them entail. Then you talk about your financing decisions. And the third type is your dividend decisions. So let's go one by one. If I first talk about the investment decisions, basically just, by the name, you will be able to arrive at the, thought that perhaps this has something to do with the investments that a business is making. So yes, you're absolutely right. Investments are nothing but the projects that a business is doing. Wherever it is putting its money to generate the return is where the business is investing. So all of the decisions which pertain to investment, it could be investing in, assets, It could be investing in specific projects. So all such decisions which financial managers have to make fall under investment decisions. So this primarily will concern about your non-current assets, how they have to be invested in different places. Now, if I talk about financing decisions, this primarily, as the word suggests, will deal about how the finance is raised. So how you're going to raise money, from what source you're going to raise money. So all of the decisions, which fall under this category will fall under financing decisions. So perhaps I have an investment opportunity and, I'm going to make immense profits from that, but I do not have the money at the moment to invest in that. So through financing decisions, I will be able to find out how much money do I need, and which sources should I get it from. Should I get a bank loan? Should I give should I get a debt, or probably issue debentures? Should I raise more equity? So this is how financing decisions will tell you how you have to raise the money, how much you have to raise from which source. So this is what financing decisions will entail. Now coming to the last decision, which is your dividend decisions. So like the name suggests, dividend. So basically, the business is in the market for making profits. Now, once the business has earned the profits, what does it do with its profits? Does it, invest that money again into the company, or does it pay the dividends to the shareholders? So this decision will be taken under dividend decisions, that whether you should be paying the dividend, and if you're paying the dividend, how much dividend should be paid, how much should be retained in the company. So all of the decisions which pertain to dividends, this will come under the dividend decisions. So all of the decisions that you take under financial management will fall in either of these three categories. Now, these are the three decisions. Now, once you have understood what these three decisions are, it's also very important to understand the relatedness of these decisions. Now, what do you mean by interrelatedness? This means that what you do with one decision, the other decision is going to get affected. So let me give you an example. Perhaps you have decided to increase your dividends. So let's suppose we have this example where you have taken a dividend decision that dividends are going to increase. Now, what will happen is, if you have paid a greater chunk of your profits as dividend, then if the business gets a good investment opportunity, then it's out of money because majority has been paid out as dividend. So it will need more finances. So then it will also create an increase in need for finance. So once you have paid out more money as dividends, you will also need more finance to perhaps fund your other projects which you are wanting to invest in. Similarly, if you have increased your investment, let's suppose I've bought a very expensive machine, it cost me $10 million. Now, because I have increased my investment, again, if I have any project in which I want to invest, again I will have to look for funds. So again, this will increase the need for the finance. So this is how what you do with one decision will also impact the other decision. This is what you mean by the interrelatedness of the financial management decisions. Now let's move ahead to another topic, which pertains to how FM, financial management, is related to other disciplines also. It is related to financial accounting, it is related to management accounting. So let's see how it is related. So if I talk about financial accounting, basically what do we do in financial accounting? It's nothing but a record of your past transactions, what has happened. So you produce your P&L account at the end of the year, you prepare your balance sheet. So all of the things which are prepared under the financial accounting, how is that concerned with financial management? Whatever happens in financial management also affects your financial accounting. And how does it do that? Let's suppose we have a listed company. A listed company is the one who is listed on the stock exchange, whose shares can be traded, bought and sold on the market by shareholders very easily. So this is what you mean by a listed company. Now let's suppose we have a listed company, and because of financial management, perhaps we wanted to buy an asset, but maybe leasing it was cheaper. So we got an asset on a lease. We make the lease payments for using the asset. So what happens over here is whatever our lease liability that gets created, if you have studied financial reporting, you would understand that there's a lease liability that gets created against the right of use of the asset. So this is how a lease liability will increase your liabilities side, and it will also impact your gearing ratio. So gearing is nothing but a proportion of how much debt a company has taken with respect to its equity. So this is how all of the decisions which are taken in financial management also have an impact over financial accounting. Perhaps whatever investment projects that I take up, this is going to affect the profits that the company makes, and ultimately ROCE, which stands for return on capital employed, also gets affected because of this. And ROCE will very well form a part of your financial statements and covers under financial accounting. So this is how financial management and financial accounting are related to each other. Now let's move to management accounting. How are management accounting and financial management related to each other? So when it comes to management accounting, there are multiple of things that we do. For example, we do budgeting and management accounting. We talk about, the funds that are there with the business. So whatever is predicted using budgeting, maybe the business is going to have a deficit of cash. So if I'm going to have a deficit, and I already know that because of my management accounts, so being the financial manager, I will try to raise funds so that we do not face the deficit of cash. So this is how these two processes can help each other. Through management accounting, I'll be able to forecast that what is going to happen in the future and how I can save myself from it. So this is how management accounting and financial management are also related to each other. Now let's move to another concept which talks about strategy. So what do you mean by strategy? Even if you talk about strategy in a general perspective, not thinking from the point of view of financial management, it basically is a step, it basically is a course of action, the steps that you take to achieve something. So this is exactly what you do in financial management also. So strategy is defined as nothing but a course of objective which you take to achieve any a course of action which you take to achieve any short-term or long-term objectives. So this course of action, whatever steps that you decide to do right now, are going to help you achieve what your ultimate objective is. So for example, if you aim to pass your financial management exam, so the preparation, the revision that you are doing with me at the moment is nothing but a course of action which is going to help you achieve this objective of yours, which is to pass financial management. Now let's talk about objective. What is objective? So objective is nothing but a goal. It may be a goal which you want to achieve. So if you talk about it in a corporate point of view, so a corporate strategy will give you, a corporate strategy is nothing but a general direction for the company. So how the company is going to, do certain things, what it ultimately wants to achieve, it will take all of the steps in that direction. So corporate strategy is nothing but a general direction of the company. So in which direction are all of the efforts of the company directed is what you will call a corporate strategy. Now, there are also financial objectives. So the ultimate financial objective of financial management is, I'm sure you would know this, is the maximization of shareholder wealth. So if you ever get asked that what is the ultimate financial objective of financial management, it will always be the maximization of the wealth of your shareholders. Now, once we have covered this, there are a few calculations which get introduced in this chapter. So first calculation is your total shareholder return, which stands for TSR in short. So what do you mean by total shareholder return? First of all, before you try to understand what the formula is, you need to think about this yourself first, that what do the shareholders actually get from investing in a company? So usually your return can be in two forms. The first form of return is the dividend that the company pays you, and the second thing is the capital appreciation. So let me give you an example of both the things. Let's suppose I bought a stock of, let's suppose ITC is a company which is listed on the Indian stock exchanges. Indian stock exchanges are Bombay Stock Exchange and National Stock Exchange. So let's suppose I own maybe 100 shares of ITC at present, and I bought them at 400, and presently the price in the market is around 430. So this is what the situation is at the moment. Now during the year, the company also gave a dividend of 2 rupees per share. So because I have 100 shares, I got a total dividend of 100 multiplied by 2, which is 200 rupees. So this is first return that I have gotten from my investment. And the second return which I have gotten is the fact that I got these shares for 400 rupees, and now these shares are trading at 430. So the difference between them is something which I have also gained. So this is also my return. So what is my gain over here? 430 is the current market price. My cost is only 400. So this gives you 30, and if you multiply that by 100 shares, then that means that's the gain that I have. So 3000 is my gain when it comes to the capital gain that I have had. So let us now come at the formula. So if I want to find out the total shareholder return, or TSR, so my formula is going to be, first of all, let's take into account the capital appreciation. So it's going to be the closing share price, subtracted from, you subtract your share price at the beginning. So the initial one, which over here was 400. So this is the share price at the beginning. And then you ultimately divide that with the share price at the beginning, so that you get in percentage terms that how much you have actually gained. So multiplied by 100, this gives you the first portion. This talks about the capital gain which you have had. Now you have to add the dividend element to it also. So you can add it over here. So this becomes plus the dividend that you have gotten. So you can add the dividend over here, do this entire calculation, multiply this entire calculation by 100 to obtain a percentage of your total shareholder return. So this is the formula which we have for TSR. Another formula which gets introduced in this chapter itself is the EPS formula. This stands for earnings per share. So over here, you're trying to find out how much have you earned when it comes to per share. So if I have 10 shares and I have earned 100 rupees, how much I've earned per share is what I'm trying to calculate over here. So how do you work this out? This is, the numerator is your profit after tax. You subtract your preference dividend from this, because that is the money that ultimately gets remaining for the equity shareholders, and then you divide that by the total number of shares. So total profit is up for all of the shares. Because you want to find it out for one share, that is why you divided by the total number of shares that the company has. So these are the two ratios that get introduced in the very first chapter. Now let's talk about NPOs. I'm sure you would have heard about it. So NPOs stand for not-for-profit organizations. These are, institutions which do not run for making profits. They have some charitable motives. It could be a charity, it could be a hospital, it could be, some school which is not running for profits. So this is how NPOs work. Now, how do you evaluate whether the NPO is doing good or not? For a general company that's there on the stock exchange, you see the profits that they are making to judge whether they are doing well or not. But NPOs do not have that objective in the first place. So how do you judge whether or not they are doing well? This gets judged by the 3 E's that we have, which is called value for money. So because they do not work for making profits, they are supposed to generate value for money. Whatever they do, they should be doing good with it. So how do you judge? The 3 E's are, first E is your economy. Now, how do you judge economy? Economy means minimizing the cost of your inputs. Cost of inputs. So whatever inputs. So firstly, if I talk about, let's take an example of a charity which has a hospital. So if I have a hospital, what are going to be my inputs? My inputs are going to be, the fees that I pay for doctors, for nurses, the medicines that are going to get consumed in the hospital. So economy would mean I would try to minimize the cost of the inputs that I'm using. So perhaps trying to negotiate discounts with suppliers, stating that we are a charity, we are not running for profits. So this is what economy would be judged as. Then the second E which we have is efficiency. Now, how do you judge efficiency? Is that you have to maximizing the output to input ratio. Output to input ratio, which means for the inputs that you have used, you have to try to maximize the output that you have achieved. So if, generally 10 doctors can treat 100 patients, I would said to be efficient. I would be, called efficient if those 10 doctors actually end up treating 120 people. So I'm minimizing the input and maximizing the output. So this is what efficiency would be judged as. And then the third E that we have is effectiveness. Now, how do we judge effectiveness? Effectiveness means using your resources effectively. So perhaps if there are ambulances that the hospital has, so whatever is the number of ambulances that I have, all of them are being used to the very effective potential that they can be used. So these are the 3 E's which are used to evaluate whether an NPO is doing good. Then the next thing which is a concept in this chapter is the agency theory. Now we are returning back to the profit-making companies. Now what happens is that when, basically we all know that shareholders are the real owners of the company. But does every shareholder have the time to run the company, to take the day-to-day decisions of the company? No, right? So what do? Shareholders, to run their company on their behalf, they appoint who? The board of directors. They give them the powers of the company so that they run the company on their behalf. They have given the investment, but they do not have the time to run the company on a day-to-day basis. That is why they appoint as an agent the board of directors who are responsible for the day-to-day working of the company. So this is what agency theory is. Shareholders over here are your principals. So there is a principal agent relationship, and the board of directors are the agents who run the company on the behalf of the principal, who are the shareholders. Now this is what the agency theory talks about. And then if we discuss who are the stakeholders of a company, so the stakeholders of the company are many. So to name a few, employees are a stakeholder. So stakeholder could be any person who gets affected with what the company does. So employees definitely get affected, the management gets affected, the shareholders get affected. What else? Your government is affected with what you do. Perhaps if you're not following the rules, they will levy fines and everything on you. And then the last stakeholder is the society in general. Whatever you're doing to, produce goods in the economy, perhaps you're harming the environment while you do that. So this is how society is also a stakeholder when it comes to, any business, thinking about who are the people who get affected by its operations. Now, the second last topic for this chapter is corporate governance. So corporate governance basically is a concept wherein So basically what happens is now the shareholders have actually appointed the board of directors on their behalf to run the company. Now there can also be a situation where the directors may try to keep their interests first, maybe try to maximize the amount of money they earn, maximize their salaries, maximize their bonuses. So there is a possibility that the directors begin to keep the interests of their own before the interests of the shareholders, which is not right, because ultimately shareholders are the people who have invested the money and they are the real owners of the company. So corporate governance basically is the system or the way in which a company is governed, system in which companies are. So by governance, we basically mean being controlled and directed. So system by which a company is directed and controlled is what you will define corporate governance as. Now there are a few principles for corporate governance. What should be there in a company so that this conflict does not arise? So principles of good governance. The first point over here is that there should be a separation of the CEO, which is the Chief Executive Officer, and the chairman. So that means basically that the person who is responsible for the day-to-day operations of the company for maximizing the profits, which is the CEO, should not be the same as the chairman. Chairman should be an independent person who whose primary duty is to ensure that the company is doing nothing wrong. There are no frauds that the directors are trying to commit. So this is why there should be a separation of CEO and chairman. Then the second principle that we have is that there should be a balanced board of directors with independent NEDs. Now, what do you mean by NEDs? NEDs are non-executive directors. These are people who get a fixed salary. They have nothing to do with, how the company is doing. Their only role is to ensure that whatever the company is supposed to do, it's doing only that, and it's not doing anything which it is not supposed to do. So independent NEDs have no interest in the company. Their bonuses are not linked to profits, unlike executive employees and directors. So board should be balanced with independent NEDs so that, just if, all of the people who wish to make profits are sitting on the board, then they probably might take some decisions which in the longer run may hamper the company. So this is why there should be a balanced board with independent NEDs. If there are executive directors, there should also be non-executive directors who should from time to time, point out the mistakes that perhaps the executive directors are making. Then the third principle which we have is that the remuneration committee should consist of independent NEDs. Now, first, let's understand what's a remuneration committee. So, remuneration committee is nothing but, the committee that gets formed in a business to decide what is going to be the pay of the executive directors. So, talk about the CEO, talk about the CMO, the Chief Marketing Officer, the Chief Financial Officer, CFO. So, what is the pay that all of these people are going to get? So no person directly should be involved in deciding their pay. Obviously, they would want to pay themselves more. The CEO would want more salary, CMO would want more salary. So that is why in the remuneration committee also, it's mandatory to have independent NEDs so that they give them a fair salary rather than, they themselves giving a good salary to their own. Then talk about the fourth point over here, which says that no director, which I've already covered here, no director should be involved in setting own remuneration. So if I am a director in a company, I should not be involved in deciding how much salary I would be getting, because otherwise I will try to set it as high as possible. Then the fifth point, the last point that we have, is that the company should have robust internal controls. So perhaps if you have studied audit exam already, you would have a very good idea of what internal controls are. Those of you who have yet not, so internal controls are basically a system of checks and balances that a company imposes within the organization. So it could be, using of ID cards to enter the business premises so that no one else from outside is able to enter. Probably, setting people to authorize payments so that no payments are made which are not really needed by the business. So these are a few examples of internal controls which can be put in. So to have a good corporate governance, it is important that the business has robust internal controls. The business should have strong controls which prevent any wrong thing from happening in the business. So with this, we have come to an end to chapter 1 of your FM exam. In the following videos, we are going to be revising further chapters. Each video will cover one chapter. I hope that this was something which helped you revise your concepts which you have studied, and all the very best for your exam. I'll see you in the next video.